If you've invested in shares, it is vital you understand the tax implications. Dividends, franking credits, capital gains, it can all get a little bit confusing. Well, today I'm here to explain to you everything you need to know when it comes to tax on shares. Hello everyone, my name is Ethan Rooshock and today I'm going to be going through the tax implications on shares in Australia. I'll be going through the impact dividends have on your tax returns, how franking credits can help, and how capital gains works. Let's start with dividends. And dividends are likely the first time that you experience a taxing event on your shares. And this is because the actual process of buying shares isn't a taxing event. Dividends are a payment from a company to its shareholders out of its profits. Think of it like a reward for holding the shares. And this is one of the ways that you can start to earn income by holding shares. Now, this income that you receive in the form of a dividend forms a part of your taxable income. Now, a dividend can vary year to year, so a company doesn't have to declare the same dividend every year. This can change, and some companies don't even declare a dividend at all. Now, a dividend is paid to you proportionate to the amount of shares you own. And the best way to explain this is through an example. So we might have a company and they've got 1,000 shares on issue, and they're going to issue a $5,000 dividend. So this will need to be split in proportion to the shareholders. So every shareholder will get a $5 dividend. So we're going to use an example of someone who owns 100 shares in that company. So their 100 shares will result to them in a $500 dividend being paid to them. Now, this dividend may be held by a husband and wife, so it might get split 50-50. But in general, that shareholder, whether it's an individual, a partnership, or maybe it's a company, they will get a $500 dividend based on their shareholding. Now, franking credits is where it gets interesting. Because if this company is based in Australia, then they may attach a franking credit to it. And this is to avoid double taxation because the company itself that has earned this income has already paid tax on these profits. So they now can potentially flow those tax credits through to the shareholders. This is where we get three terms. We get fully franked dividends, which is where the whole dividend includes franking credits. We get partially franked dividends, which is where only a portion has franking credits attached. And unfranked dividends, where there is no franking credits. Now, to work out your franking credit, there are a few formulas you can use, but there is calculators like this one here. So we can put in our $500 dividend. We assume it's fully franked, so 100% franking, and the rate of tax is 30%. And this spits out a franking credit of $214.28. Now, this is going to mean that the impact on our taxable income is going to be the dividend that we receive, the $500, plus the franking credit. So we're going to receive taxable income of $714.28 in this example. Now, the way our tax system works in Australia is this is going to be taxed at the individual level. So we're going to look at our marginal rates here. And in essence, we know that we've had a rate of tax on this income of 30% paid. So the difference in tax is going to be the difference between our marginal rate and the 30%. So let's use the example of someone that's earning $100,000 and their effective marginal rate is going to be 34.5 cents once we add in the Medicare levy. So the tax on that dividend of $500 is going to be $246.43. So the additional tax between the franking credit versus what we need to pay is only $32.15. So you can see the benefits of receiving fully franked dividends are that the tax credits are going to massively reduce your potential tax liability. Now, it can even go the other way, that if you've got no other income, the dividends are all you're receiving, your effective tax rate is 0%. So you're actually going to get the full franking credit back if you remain under the tax-free threshold. So this is why some people in retirement are still lodging tax returns, because they may hold some dividends that are receiving franking credits and therefore they're lodging returns so they can get that back. Now, you've made the decision you want to sell your shares. What happens now from a tax point of view? Well, you're going to either have a capital gain or a capital loss, or I guess there might be some situations where you come out perfectly even. In general though, a capital gain or a capital loss is calculated by looking at our sale amount less our cost base. Now, this incorporates all fees. So we're going to go back to that same example, and we've got 100 shares, and we paid $20 each for them. So $2,000, but we also paid $10 in brokerage. So our total cost base is $2,010. So if we decide to sell our shares, they're now worth $25 each. So we're selling all 100. So 100 by the $25 each, we're going to get $2,500, but we do have to pay $10 brokerage. So our final sale amount is going to be $2,490. Now, to work out our capital gain, we simply take the $2,490 less the $2,010 cost base, and we're going to get a final capital gain of $480. Now, the great thing with capital assets is if you've held them for 12 plus months, you may be eligible for the 50% discount. So if you're an individual holder, you'll get a 50% discount on this. So in our situation here, instead of having a $480 gain added to our taxable income, we're only getting $240 get added to our taxable income. Now, if you're investing in a company, the discount doesn't apply, and there are different rates for super funds. Now, there is no separate capital gains tax. It just simply gets added to your taxable income. So we've now got $240 that gets added to our taxable income. And if we go back to that early example where we had $100,000 of other income, so our tax rate is at 34.5 cents. So our total tax is going to be $82.80. So you can see at the time of the actual sale, we've received $2,490 in proceeds. We're then going to have to pay $82.80 in tax. So our final proceeds that we're left with is $2,407.20. And our real gain after tax is $397.20. So some people get worried that, oh, well, if I sell all my shares, I'm going to lose half of it in tax. And in most situations, that's just not going to happen. It's going to depend on what is your actual capital gain, what is your tax rate, and then that'll determine how much tax you'll actually pay and what you'll be left over with. So in summary, there's no tax when you actually buy shares. The taxing happens via either dividends or capital gains. Dividends can have franking credits attached, which can reduce the tax impact to you at an individual level, and capital gains can be reduced by a 50% discount if you've held for 12 plus months in most situations. There are a range of other topics when it comes to tax on shares, such as dividend reinvestment plans, share buybacks, or even ETFs. So drop a comment down below on what you want me to cover next. I thank you for watching. I'll talk to you again soon.